Have you ever wondered what 3 times long and 3 times short really mean? In the world of leverage trading, these terms often come up, and they can be quite confusing at first. However, once you understand how they work, you'll see why they are popular among traders looking to maximize short-term profits. Let's break it down step by step. First, let's talk about 3 times long. What does long mean in trading? Simply put, going long on a stock means you are betting that its price will go up. Now, the 3 times part refers to leverage, meaning your potential gains or losses are multiplied by 3. Here's how it works. Imagine you invest in a stock that goes up by 10% in a day. If you hold a regular stock position, you would see a 10% gain. But if you hold a 3 times long product, your gain would be tripled to 30%. Sounds great, right? But here's the catch. If the stock drops by 10%, your loss would also be tripled to 30%. In summary, 3 times long amplifies your exposure to upward market movements. It is designed for those who believe that a particular stock or index will rise significantly in a short period. However, remember that leverage works both ways. It can amplify your gains, but it can also amplify your losses. Now let's move on to 3 times short. This product works in the opposite direction. Instead of profiting from a stock going up, 3 times short products are designed to profit when a stock's price goes down. Essentially, you are betting that a particular stock or index will drop. For example, let's say a stock falls by 10%. If you hold a 3 times short product, you would see a 30% gain because your return is 3 times the percentage drop in the stock. But if that stock goes up by 10%, you would lose 30% of your investment. Therefore, 3 times short is a useful tool for those who expect the market to decline and want to profit from that downturn. Now you might wonder why people use these products. The main reason is short-term trading opportunities. These products are ideal for day traders or those looking to take advantage of sudden market movements. But there's a big warning. Both 3x long and 3x short products come with a daily reset. This means the leverage applies to each day's performance, and if you hold these products for more than one day, your returns can differ significantly from what you would expect based on the underlying stock's performance. Let me explain why this happens. The daily reset means your gains or losses are compounded each day. If a stock goes up one day and then down the next, your overall return might not match the simple math of multiplying the stock's performance by 3. This is because the leverage is recalculated every day based on the new starting point. For example, let's say a stock rises by 10% on day 1 and then drops by 10% on day 2. A regular stock investor would roughly break even after those 2 days. However, if you were holding a 3x long product, you would suffer a loss due to the compounding effect. The return is not a simple sum of gains and losses but rather influenced by the daily recalibration of leverage. Let's break it down with numbers. Suppose the stock price goes from $100 to $110 on the first day, a 10% rise. On the second day it drops by 10%, bringing the price back to $100. A regular stock investor would have recovered their initial investment. However, if you were holding a 3x long product, the value would increase by 30% to $130 on the first day. When the stock drops by 10% on the second day, the 3x long product would lose 30%, reducing its value to $91. In this case, the regular stock investor breaks even, but the 3x long holder incurs a loss. When should you use these products? 3x long is suitable when you are confident that a particular stock or index will rise in the near term. 3x short is ideal when you believe the market is about to experience a sharp decline. However, both products require careful risk management. They are not suitable for everyone, especially not for beginners. One final thing to keep in mind is that these products are different from regular stocks or ETFs. They do not represent actual ownership of the underlying stock. Instead, they are structured as ETPs, exchange-traded products, that use complex financial instruments to achieve leveraged returns. In summary, 3x long and 3x short products are powerful tools for experienced traders looking to take advantage of short-term market movements, but they also carry significant risks. Always understand how leverage works and be prepared for both amplified gains and amplified losses. If you're considering using these products, make sure you have a solid risk management plan in place. And remember, with great reward comes great risk. Use these tools wisely and only if you fully understand how they operate.